Hey, my friend Stephen Brooks here, and I teach traders who have $25,000 or more in their portfolios how to generate a fairly reliable salary trading as much as 2 hours a day, as little as 5 minutes a week. Plus, we have an AI automated trading bot that does a lot of the heavy lifting for us. Now, a lot of what I do, and the reason I was able to go from a broke minor league baseball player who blew up 2 trading accounts to where I am now, trading a multi-7-figure trading account, really the big shift for me back in the day was trying to be data dependent, right? My opinion of where a stock might go, or my opinion of entries and exits, never really panned out to be very good. It wasn't very consistent, it wasn't very reliable, and thus I didn't get very good results at all. But once I recognized that my opinion of the matter, my opinion of what the market would do or what a stock should do, when I recognized that that was probably not a very good way to go about trading the market, I started to ask myself, well, what would be a better way to go about it, right? At that time, I was making $1,200 as a minor league baseball player, and I needed a way to make more money. And I thought trading would be a fantastic vehicle for that. Now, when I first started, that wasn't the case, but it turned out to be the case. And the big shift for me going from not making money, inconsistent, blowing up accounts, to consistent making money was being data dependent. Meaning, I would run very large tests. I'd get data from like a 15-year, or maybe back then it was a little bit less, but now it's somewhere like 20 years worth of data is what we have. And we run a test over that particular trade or that particular strategy over however much data we have. And again, now it's at the point where it's like 20 years. Maybe back then it was more closer to 10 years. And when you have a big enough sample size, like thousands of trades, to me that is statistically significant enough to be able to say, hey, it's not going to be exactly the same moving forward because it never is, but it's probably going to be relatively close. So the shift that I made from unsuccessful, which is going off my opinion, what I thought should happen, to being successful, which is what does the data say to do at this time and point? What does the data say to do in this juncture? That really made the biggest shift for me. And everything that I've ever done in terms of coaching or educating others was always following the model of here's data that shows if you do this at this time, roughly this is the result you should expect. Really, everything that I've done in terms of coaching people really is 100% revolves around data. And one of the questions I get that I'm going to answer today on this video is, how do we know if a trade is no longer effective, right? Because when we do a back test on a trade or on a model, we're not going to move forward on anything unless it has a positive expected return per trade when you include commissions. And most of the time, we like it to be over $100 so we can factor in things like slippage, et cetera, et cetera. But when we have something like that, and then we start to do it moving forward, if it's not working within the parameters that we hope it will, that we expect it to based on the previous data, how can we tell if this is a system that is just no longer going to be effective, right? The thesis, if you search online, the thesis is there's no one strategy that works forever. Now, I strongly disagree with that. That's not the purpose of this video, but I do strongly disagree with that. So the question is, how can I tell? How can I surmise? How can I formulate if a strategy that worked for the past, let's say 15 or 20 years, that's not really doing super well right now, how can I tell if that strategy is going to be no longer effective in the future to the point where I should basically cross it off my list and never do it again? And I've actually been able to distill this down to a number of things to be able to tell that. And really, I would say there's probably 3 things that you should ask yourself to be able to determine if a strategy that used to be effective, that's no longer effective, if it's going to continue to be potentially no longer effective in the future. So there's 3 things. Number 1 is make a comparison of what the sample size is of the test that you ran versus the sample size of the trades that you've done. Right? What is the comparison of the sample size of the back test or the study or real results from other people using the exact same model versus the sample size of what you've done? right? If we're looking back 20 years, we're looking at a sample size normally of between 5,000 and 10,000 occurrences. That is substantial. If you're looking at 10 trades, how do those really line up? Right? Does something like, do you think the result of 10 trades is statistically significant compared to 5 to 10,000? Probably not. I would argue that whatever the test is that you're going based off of, right? Whether it's, again, other people's results using the exact same model, whether it's just a back test, whatever it is, I would argue that you want to get to the level of occurrences that are at least 10% of the total back test size, or again, whatever the previous results are. This way, you at least give the trade a little bit of time to be able to work itself out and get anywhere close to a level of statistical significance that you could be able to make a really unbiased and data-dependent judgment on if it may work in the future. So again, if there's a trade that you have 5,000 back-tested occurrences and you haven't done 500, to me, that's probably not enough occurrences to be able to say this works or it doesn't. So that's the first thing. How many occurrences am I making my judgment off of compared to how many occurrences have I seen over the past however many years when it comes to this strategy? So that's the first thing. The second thing is I need you to ask yourself the question, whatever the framework is, whatever the system is, whatever the strategy is, the results that you've gotten via trying out the method or the system or the framework, have you actually followed those rules to the T? Like however many trades you've done, have you truly followed the rules of that strategy or the framework of that strategy or the system? Have you ever done that where you actually followed the rules 100% to the T? Now, in my experience, more times than not, this is where everyone kind of fails really badly, where they learn a strategy that has certain results. They do it maybe a handful of times. They don't follow the rules even closely sometimes, and they say, oh, that doesn't work. Again, if we're looking at hundreds of examples of a particular trade where you buy here, sell here, you buy here, sell here, and then you go out there and do 10 where you buy here, sell here, that is not an apples to apples comparison whatsoever to what you're set out to do. So if you do, let's say 10% of the size of the number of occurrences that gave you the idea to move forward and do this trade, you have to make sure that those occurrences that you've done, or you have to really be a stickler, were the occurrences that I did, I actually follow the rules of that framework or that system to the T? 99% of the time, the answer is absolutely not. The answer is absolutely not that you follow the rules of the system to the T. And again, I see it time and time again. A lot of people will they'll get something that works, a framework that works. They'll do it 5 times. They won't follow the system at all. And then they'll say the system didn't work when those occurrences that you did weren't even the actual system. And in most cases, they weren't even the actual system at all. And then the last thing I'll say is, or the third thing that I would kind of ask myself is, did I use proper trade size on those occurrences? Now that kind of bleeds. The second and third ones, as I'm saying it out loud, are kind of bleeding together because improper trade size, too much risk, is going to force you to not follow the system to the T. You probably will hold on to losers a little bit longer than you're supposed to. You'll probably exit winners at the first sign that they're green as opposed to holding on to them for a little bit. You'll probably double down or add to positions. And the outcome of that is you're just not able to follow the strategy or the actual system to the T. So again, everything that I've ever done when it comes to trading, at least to be successful, because I wasn't successful when I started, not even close. But everything that I've done to be able to be successful in the market is due to me being data dependent and data driven, right? So if I see a trade that says you buy here and you sell here, and if you do that, you're supposed to make about $120 per trade. The reason that I'm really good at this is because I will do that to the T. And I won't try to say, well, this is the one time out of 10 it's not going to work. Or, oh, maybe this particular trade, I should do this or this as opposed to what the rules are. That's the reason I've been successful. And what I see is for a lot of people who struggle is they get a system, they get a framework that works. Let's say it makes you $100 per day. And then they don't follow the system. Most times it's because they use way too large of trade size. And then they come back and say, hey, the system didn't work. And then what we say is, how do you know the system didn't work? You didn't even do it. Right? So again, a lot of now in 2024 and beyond, artificial intelligence, what it's really going to do is it's going to afford individual traders the opportunity to get access to data that they weren't really able to get before, and a lot quicker data. And what that's going to do is that's going to open up a whole new world, if you will, a blue ocean, if you will, of potential opportunities for the non-professional trader and the non-professional investor. You're going to find out about trades now, this week, next month, over the coming years that have statistical significance that show a positive expected return per trade. Meaning, if you take every single trade that was done, you take all the profits, you subtract from it all the losses, and you subtract from it all the commissions, it comes out to be, and you divide it by the number of trades in that data set, it's going to come out to be a positive number. You're going to hear about a lot of those. You're going to see a lot of those. And it's your goal to be able to make the judgment of, is this something that can continue into the future for me, or is this something that absolutely sucks? Is number one, have I done it enough the right way with the right trade size to be able to make an actual comparison, right? Have I done it with 10% of the statistical significance that I'm relying off of for me to decide going ahead and using this trade or not? And then the last thing I would say is also take a look at the results I'm getting right now. Has this happened before? Because more times than not, it has happened before. Remember, the S&P 500, if you zoom out to a yearly chart, it's got a very smooth equity curve up and to the right. But if you look at a daily chart, it's all over the place, right? It's all over the place. So again, AI is going to be very big moving forward for non-professional traders. It's going to give you access to a lot of data. Use it wisely. Again, get as much data as you can to determine if a strategy might make sense for you. Then do it enough to where you have some semblance of statistical significance to be able to make the judgment of, hey, this looks like it's working for me, or it looks like it's not working for me. Make sure you're following that strategy to the T, because 99 times out of 100, you don't. And then also, if those things are all true and you still are getting to the point where this is giving me a negative outcome, ask yourself, has this type of negative outcome in whatever time frame I'm basing this decision off of, has this happened before? Right? Has it had a losing week? Has it had a losing month? Has it had a losing quarter? Odds are it probably has, because nothing works every single day, all day. So again, use the data wisely, but use it to your advantage. Make sure your statistical significance is high enough. Make sure you're actually following the model properly. And then at the end of the day, make sure that the results you're getting, whether they're positive or negative, have happened before. If none of those things are true, then the strategy is unlikely to be reliable moving forward. But the problem is that's almost never the case. I'll see you in the next video.